Okay, so we'll start off with the TRS Retirement Formula, which is basically one of the main, a lot of the questions that we get, when working in the school district space, when we're trying to determine, okay, so how much am I going to actually get when I retire from TRS, right? And this is a simple formula. And this is kind of give you an example. And the reason why it's so important to understand this is because, just like Social Security, when you're working in the private sector, when you retire and when you reach that age where Social Security comes in at 62, or if you wait a little longer, majority of the time, or literally all of the time, that is not going to be enough to supplement or to take care of your needs in retirement. Okay. If you're currently making, usually when you retire with your TRS pension, you're going to lose a good chunk of your income that you've been making. So if you don't do anything to supplement that now to prepare yourself for when you actually do retire, then it's going to cause you to put you in a scenario to where you may not be able to retire when you want to. You might have to work a little bit longer. And we want to do what we can to kind of catch you guys early and make sure that you guys are preparing. So just as an example, if you want to do the calculations yourself and plug in your own numbers based on your specific scenario, you basically just take the years of service, how long you've been working, the state factor, which is going to be 2.3%, which will tell you that your state multiplier is going to be 69%. And then your average 3 to 5 years of your highest income. And it's going to tell you that based on that calculation of average income of $60,000, the maximum benefit that you can receive is going to be $41,400, right? So if you see on the slide, you lose about 31% net loss of your gross income. So how do we figure out a way to supplement or replace that 31% that we're going to be losing? So a number of options that we have are going to be employer-sponsored plans that you might have already come across. Some of you might already be invested in these plans, but you're gonna have your 457, your 403B. If you're doing something outside of your employee-sponsored plan on your own, then you might have something like an individual plan, like a traditional IRA or a Roth IRA. And if you're just investing outside of just retirement in general, then you might have some sort of a brokerage account, at TD Ameritrade, Charles Schwab, or some of the brokerage houses out there where you're just investing on your own. And then also obviously savings accounts, so on and so forth. I know you guys most likely have heard of a lot of these accounts in your time. So to kind of go over the differences between the two, because this is probably a good chunk of my conversations on a daily basis, is really just kind of educating what the 457 is, the 403B, and the main differences between the two. I will leave this up here for a little while. I'm not going to go line by line, but basically the main difference I like to highlight on the differences between the 457 and 403B is going to be the accessibility. When you invest in a 403B or like a traditional IRA or a 401k if you're in the private sector, the IRS are going to have rules that says when you can access this money without penalty. There's going to always be an age attached to it, and currently it's 59 and a half. So one of the biggest differences is if you have a 403B and you separate from education or just retire early at 50, 55 years old, well, you wouldn't be able to access the money in your 403B without having to worry about some sort of early withdrawal penalty, and that's going to be at 10%. The 457, it does allow you to access the plan in the event that you do retire at 50 or separate at 50, then you can actually go into your 457 plan. You can take it out. You still would have to pay taxes, the applicable taxes based on whatever your tax rate is at that time, but you will not be penalized for taking the money out early. So those are the biggest differences. As you can see, a lot of times the 457 compared to 403B, the fees are usually going to be a little bit lower than most 403B plans. Your investment options are going to vary between the two plans. And investment committee advisor oversight, which is really big. So when you have your 457 through TCG, just to give you an idea of our process, we're going to take a look at all of the funds that we supply in the 457 for our school district. And we're going to monitor these investments over time throughout the year. If these investments do not meet our strict criteria in terms of performance and fees, then we actually will go in and replace these funds and replace them with funds that actually meet our criteria when it comes to performance and fees. So what that means to you is that you can feel confident that you always know that you're going to have somebody watching to make sure that the best investment options that are out there for the most part are available to you to choose without you actually having to conduct that own research on yourself. As far as contribution limits, those are relatively the same. There's some subtle differences, and we can kind of go over that, more detail in another conversation. But for the most part, $19,500 is the amount that you can defer. If you're over 50, there's going to be a catch up where you can actually put in a little bit more into the plan. And then we can discuss if that makes sense. If you financially, we can talk about whether or not that makes sense for you and your specific scenario. One question I got on the last webinar I did was, can you do both at the same time? And that answer is yes. If you do have a 457 and a 403B, you can absolutely contribute to both at the same time, and you can actually max out both at the same time as well. Not everybody is in a position to where they can do so, but if you find yourself in a position where you're maxing out one plan and you still have the ability to max out the other plan, then you have the ability to do that with both of these plans here. And that's a conversation that we can always have one-on-one to kind of talk about the best options and alternatives for that as well. Okay, so when you retire, okay, so a lot of people another big part of my day is, once we retire, once we separate from employment, what can I do? Do I leave it? Do I roll it over? Can I move it, take it? What's the scenario in that regard? So essentially, when you retire, I usually going to recommend that you roll over your plan to an IRA, depending on the type of account that you do have, or how you actually invest it into the 403B or 457. And that's something that we can sit down with you and talk to you about in terms of your investment options. You don't have to take it with you. You can leave, but traditionally a lot of people tend to, when they separate from their employer, they just take everything with them. If they're in a 401k, if they're in a 457, 403B, they're usually going to roll it over into the applicable IRA type account, so that way they can continue to still defer the taxes until they actually need the entire amount of money. The IRS 20% withholding distribution, that's simply as if you leave at 50, or even if you leave at 60 years old and you just decide, this is what I'm going to do. I'm just going to take the entire $300,000 out of my 403B, and you just cut me a check. In that sense, the IRS has to withhold 20% if they're making the check payable directly to the participant when you leave the plan. My recommendation is never to do that. I'm always going to recommend that you just roll it over to your IRA, continue to defer the taxes as long as you possibly can, and then just take out money as you need it, and then pay the applicable tax on the amount that you take out throughout the year. A lot of times you're going to get approached by a lot of investment providers, insurance agents, broker dealers, RIAs, or registered investment advisors. So you want to make sure that you understand, who these people are, how you can utilize them, and just making sure that you understand who you can trust. You definitely want to do your research. Broker check is one great way to go online, and you can just check any advisor that you're working with to see how they're registered. You can obviously Google both the individual and the firm as well, and that might be able to provide you some information also. And then if you have any questions about that, you can always reach out to TCG. TCG is a registered investment advisor, so we are a fiduciary. The reason why that word is important is because we are required by law to do what's in the best interest of our client before what's in the best interest of myself, and before what's in the best interest of the firm. Okay. With broker dealers, they are required to be suitable. And what that means to you is that when they recommend an investment product, that it just has to be suitable. It has to meet your needs. It doesn't necessarily mean it's the best for you, but it is a suitable recommendation because it does match your risk, your time horizon, and what your goals are. But it may not be the best product out there, and that's why you always want to make sure you understand who is giving you this advice and why. Understanding fees. So anytime you're investing with anyone, you definitely want to understand what you're paying. And in terms of, there's always going to be different types of fees in our industry, the upfront sales charges and commissions, that basically if you're investing in some sort of a mutual fund, a lot of times if they have upfront sales charges, they might charge you 5% just to get into that investment. So what that means to you is that you have to earn 5% just to break even. And then you have to earn a little bit more to actually start getting an actual return, right? So there are a lot of investments out there that do not require that. So it's important to understand when you invest how your money is working for you. Wrap account management fees are simply the fees that you pay to an advisor or to a money manager to actually invest the portfolio for you on an ongoing basis. They monitor the portfolio and make sure they make the changes based on your risk tolerance and your time horizon, your goals, and things that you guys have already discussed at the very beginning, what you're working on. And then you're paying for that manager to actually provide a service to manage that money for you on an ongoing basis. In 12B1 fees, these are, generally, like I said here, allows distributors to compensate broker dealers and representatives for selling their funds. It covers marketing fees. Usually you're going to see these in mutual funds pretty much all of the time. A lot of times you're not going to really know what it is unless you're looking in the fine print, but they're without a doubt in there somewhere. And then your withdrawal charge, aka surrender charge. So a lot of teachers that I've worked with now that have had 403Bs set up for a number of years, they've started it when the 403B was pretty much kind of annuity based only. And even if they weren't annuity based only, they were sold an annuity. And then with any annuity, there's always going to be some sort of a surrender charge. And that just says that, okay, if you want to change this investment and get out of this annuity and get into something else, well, now there's a period of time where you can do that without, there's a period of time where you have to be invested or stay in that account. If you don't stay in that account for at least a number of years, then you will get penalized if you try to take it out. I've seen them range from 7 to 12 years. So if you try to take it out in year 4, then you could be hit with a 5 or 6 or 7% penalty on the way out, and it kind of handcuffs you to staying there a little bit longer than you want to, and the return may not even be favorable enough for you to do so. And that's another thing where we'll sit down, we'll look at your 403B, we'll look at your annuity, we'll look at your surrender charge, we'll look at the potential return that you have on that annuity, and then we'll help you make a better decision. Is it worth it to just take the hit and then reinvest it into a better product for the next 10 or 15 years? Or does it make sense to let it sit into this annuity because the surrender fee is so high? And that's something that we can sit down and work on you with one-on-one to go over those questions with you as well. And the mortality and expense fee, this is pretty much for annuities and insurance related products. So I kind of went over this, I guess, in a sense. So just be mindful of the types of fees. Ask as many questions as you possibly can to make sure that you're understanding everything that you're investing in and that you're getting into. A lot of times fees are the upfront fee that's disclosed is usually just what you're paying on the management side, but a lot of times you don't know all of the other hidden fees that are inherently in there. And the reason why that's so important is because if you're paying a guy, 1.5% to manage your portfolio, and then you look at all the other fees that are inherently inside of the investment portfolio and everything else you have going on, those can start to add up to 3 and 4 and 5% of fees that you're paying that you don't even know. So that means your money's not really working hard for you. And that's the point that's the whole point of investing. We want our money to work as hard for us as possible. And any fee that we pay, it takes away from the net gain that we actually have on the portfolio. So the financial planning process. So this is my everyday bread and butter in terms of what I do with clients and what I've been doing with clients for well over a decade. So when you sit down with me, you know, a lot of times you don't really understand exactly where to begin. Maybe you don't have enough knowledge. Maybe you don't think certain things are important, or you're just going to kind of put it off until sometimes it's too late. So in a financial planning, and what should it cover? So financial planning, simply put, is cash flow planning. So what I like to say when I'm looking at financial planning as a whole is I like to look at your retirement as a business. The same way when you have a business, you're looking at your assets, your liabilities, your net worth, your balance sheet, and you need to understand exactly where money is coming in and where it's going out to, and making sure that we're doing it in the most efficient way possible, right? So where are you now? Where do you want to be? And how do you want to get there? And how are we going to help you get there? And we want to make sure these goals are realistic. So the first time I sit down with a meeting with a client, it's really just kind of an introductory to get to know you meeting. I really want to understand where you're at as a whole. Where you're at currently right now, what your goals are, and then we help you kind of form a plan to make sure that we get you there as efficiently as possible. And then we continue to review these plans on a yearly basis at minimum, like I kind of said earlier. But it's not just a yearly basis. We can review these plans throughout the year if different life events happen, if you have a baby, if you move to a different city, if your income changes higher or if your income changes lower. We're always going to look at different life events that could potentially sway our financial plan up or down, and we want to make sure we know which way it's going to go, so that way we can kind of prepare for it and then figure out what the next step would be. So when we sit down, I mean, this is kind of basic information. We're going to gather the background information. We're going to establish financial objectives, develop the plan. We're going to help execute and control the plan, and we're going to measure performance. You know, what good is a plan if you don't have anything to base it on? So once we have everything set in stone and we know exactly where we're at, we're going to measure our performance on a yearly basis to see where we're at. If our net worth continues to go up every single year, that's great. That means we're on the right track. If for some reason our net worth starts to go down on a yearly basis, then we need to figure out why that is, right? A couple of reasons could be that our assets have decreased. It could be due to market performance, where our portfolios went down. And if that's the reason why, we need to kind of adjust and figure out if there's anything that we need to tweak. It could also be our liabilities went up. We added more debt than we had last year. And then we need to understand what kind of debt that is. Is it good debt? Is it bad debt? Okay. And then making sure that we understand that, so that way we can continue to measure it on a yearly basis. And these are the types of background typically that we're going to gather. So we're going to understand where you're at TRS. We're going to look at all your retirement accounts that you have, whether they be with your existing school district, or also if they're going to be with, what we see a lot too is that when you leave from one school district to the next, you forget your 403B or your 457 at this other school district, and it's been sitting there for 5, 6, 7, 8, 9, 10 years, and you haven't been monitoring, you haven't been watching it. And I've seen multiple cases where people have multiple retirement plans, and they're all over the place, and they've never even thought once to consolidate it into one account. So that's why it's usually most important when you do leave, you usually just want to take it with you. And then we're going to get to know what you owe, right? This is going to be your liabilities. We want to know your credit cards, your mortgage, your car loans, whatever type of liabilities you have. And then understanding, like I said, at the end of the day, what is your net worth? And this is this is kind of vanilla, but I mean, at the end of the day, you know, what your financial objectives are. Everybody's going to be different. There's no such thing as a cookie cutter approach to financial planning. I walk into every meeting with a blank slate. I've probably seen it all for the most part, but every once in a while I still get, you know, a curveball thrown my way. But for the most part, I've seen a lot of different scenarios to a point where I can have a really good feel of how we're going to get you to where you need to be, and how we're going to prioritize things. And then developing your financial plan, budgeting of income, expenditures for the near term, projections of future financial position, identifying the financial instruments needed, what type of investments are we going to actually choose, the investments side, stocks, bonds, ETFs, mutual funds, the account types. So we're going to look at everything. Budgeting is probably one of the most important things that I always sit down with clients on. It's probably something I ask for in the very first meeting that we have. And the reason is, like we said in the beginning, it's cash flow. A financial plan is kind of a cash flow plan. We need to know what's coming in and we need to know what's going out. So we need to know what's left over, because what's left over is our discretionary income that tells us what can we do with this money. And if our goal is saving for retirement, and there's never been a scenario where I had anybody walk into my office where everybody was working on just one goal. There's not such a thing. You're always going to have competing goals. You're going to have retirement. You're going to have, if you have kids, you're going to, worry about saving for their college. If you have debt, you're going to worry about how am I going to pay this debt down? If you don't have enough savings, how am I going to pay the savings? If you have a family and you've never done any life insurance planning, and you might be the sole breadwinner, and wife is stay-at-home mom or vice versa, then guess what? We need to budget for life insurance. So there are always going to be competing goals that we're going to have. So we really need to understand where your budget is. And usually when I do a budget, I usually get a couple of different budgets. I usually get what I think it is, what I hope it is, and then eventually at some point I get what it actually is. And then that's the one we work with and continue to improve upon. And then executing and controlling the plan. Once we decide where you're at and what actions we're going to take, then we help you execute those actions. There's going to be times where people walk into the office and say, I want to invest, X number of thousands of dollars. After we look at the plan, they have too many other things going on that are way more important than investing. If you come into my office with $10,000 of credit card debt and it's at 17, 18, 19%, and you want to invest $10,000 into Bitcoin, I'm probably going to tell you it's not a good idea, or any cryptocurrency for that matter. I know that's the biggest topic right now everybody's talking about. So if you come to my office and tell me that, I'm going to tell you that's probably not a great idea, right? And so so in terms of executing, there's a lot of times where we might not do a lot of anything in terms of opening up new accounts because it may not be the right time to open up new accounts. It may be time to prioritize how we're going to pay down debt, how we're going to, maybe we just need to establish life insurance. Maybe we need to figure out how, with the credit card debt, how are we going to tackle this credit card debt? If we don't have an emergency saving, how are we going to, split my discretionary income to where I'm actually putting money into my savings account, but I'm also paying down debt at the same time, right? So it's not an all or none thing, but it's just making sure we understand what the priority is. And the drafting of legal documents, that's essentially going to be, in the event that, when we do some level one estate planning. And by level one, I mean, really, we're talking about getting wills done, getting durable power of attorneys, medical directives, those types of things. Just kind of really basic things, making sure that beneficiary is up to date. I've had clients that have come into my office that they've been divorced and their ex-spouse is still the beneficiary on some of their other policies or some of their other retirement accounts, and they've never changed it. Making sure all that stuff is taken care of, right? And so those are some of the things that we're going to review and look at. The investment piece of it is what I always like to call the sexy part of financial planning. Everybody wants to know, how can I make as much money as I can? But I focus on that, but we also focus on the stuff that's not very sexy too. The life insurance, the estate planning, the things that people tend to put by the wayside and never actually come back to it. And then you usually don't see it, unfortunately. You usually don't see the value in it until you actually need it. And at that point, it's too late. And then once again, I know some of it's going to be kind of repetitive. I'm talking ahead of some of the slides, so forgive me. But measuring performance is simply, just like I said, once we create the plan, we have to know how well the plan's doing on a yearly basis. And even if it's something that's imperative that we take care of in the next 30 days, we'll prioritize those meetings and we'll knock out whatever we have to knock out. Well, I'm going to give you homework. You're going to give me homework, and I'm going to have things to do. You're going to have things to do. And then some things we're just going to do together. Now, retirement income planning basically just provides a timeline year by year where your income will be generated from. So looking at three things, guarantees to ensure core expenses are covered, growth potential to meet long-term needs, and flexibility to refine your plan as needed over time. That's where your budget is going to come into very, very, high play, because at that point, we need to really understand how much income you're going to need in retirement. People that are in retirement probably budget the most because your income at that particular point is most likely going to be on a fixed schedule. Because you're no longer getting up and working every day. So what check is coming in every day or every 2 weeks, every month. And so we need to make sure we understand what that is and then figure out what the sources are. It may be from TRS, it may be from Social Security, it may be from your income, dividend and interest from your investment accounts that you've established over the years. So we'll look at all of that and then determine, okay, how much income do you need? Where are the pots of money that we can get this income, and then help develop a plan on your retirement income. So that way you can go into retirement feeling confident that you have all of your bases covered and all the boxes checked. Okay, so what type of investor are you? So if you've been investing for, any amount of time, you've probably heard, or if you've ever worked with an advisor before in the past, you probably have heard them ask you, are you aggressive? Are you moderate? Are you conservative? That we'll do a little bit better job than just asking you those, asking you to check a box between those three, because what's aggressive to me is not, that doesn't mean it's aggressive to you. And what's conservative to me doesn't mean that's conservative to you. So we really need to understand where your risk, your appetite is. So that way, when we help you create and devise this portfolio, you're not going to be staying up all night. And anytime you turn on the news and you see that the market went down a little bit and you're wanting to sell everything and put it under your mattress, right? We want to make sure that the portfolio is built and customized specifically for you. Once again, we don't have a cookie cutter approach to investing, nor do we have a cookie cutter approach to financial planning. It's all going to be a blank slate when we sit down and talk to you, and then we help to customize the portfolio. You've heard a lot of these terms, diversification, I'm sure, over the years, spreading your money through among different investments. Asset allocation, trying to understand what different the different areas that you're going to actually put your money at in the market, and then risk tolerance. Like I said, once again, your risk, your appetite for risk, and then withdrawal rate in your portfolio, which is basically just figuring out what that number is on how much you're going to draw your portfolio down on an annual basis in the event that you need to start taking from the principal. Usually, I think on average, it's right around 4%, 4 to 5% is the withdrawal rate that you're going to take down on your portfolio on an annual basis to supplement of the other sources of income like TRS, Social Security, if you have any annuities out there, whatever else you have. And these are the basic types of investments that you'll see: your cash, fixed income, which are your bonds, equities, individual stocks, mutual funds, REITs, which are real estate investment trusts, exchange traded funds, ETFs, which are obviously very popular nowadays. So there's and the list goes on and on and on, and we have access to this and more. So whatever the client needs, we're very confident that we can provide and build a portfolio around it. And some of this is kind of self-explanatory, but we'll go over this. So cash. So advantages, obviously, there's not going to be any volatility. It's not designed to go up or down really at a very high. Definitely not down, but not up at a high rate. It does have the perception of safety. Liquidity, very easy to access, and this is where you typically are going to keep your emergency funds. Your emergency funds aren't there to grow at 10 to 15% annually. They're there to be there when you need it. You don't know when an emergency is going to come, so you want to make sure that you can easily access the money in this account. The perception of safety. I always say cash is basically if you're just keeping money above and beyond what you need to have as emergency savings, and that's one of the things that we go over with. We say, how much do you actually need in emergency? You're gonna hear terms. You're gonna hear rules of thumb like 3 to 6 months. That's going to vary. It's going to be based on how many income households do we have. Is it a 1-income household? Is it 2? It's going to be based on your profession. Are you a seasonal? Is your job seasonal where there's going to be 3 or 4 months out of the year where it's going to be slow, where there might not be an income? Then maybe we need to increase our savings account. So there's just a lot of different variables that we look at. The disadvantages, like I said, inflation risk. It's basically what I call going broke slowly. If you only need 20,000 in an emergency account and you have 100,000 sitting in your savings account, and it's just, for you, it's a peace of mind thing. But at the end of the day, even though you're not losing money, it's not going from 100 to 99,000 to 98,000, you are still losing the value. Because obviously over time, that 100,000 is not going to be worth the same 100,000 today as in 10 years as it is today. Like I say, zero risk, zero return. It's a short-term asset, bank default risk. We've seen a little bit some of that, but it didn't really affect us for the most part. Fixed income bonds, advantages. So they're very easy to understand. Backed by paying entity, government, company, hierarchy of payment, and low volatility. And then disadvantages, reinvestment risk, interest rate risk, inflation risk, credit risk. So easy to understand. For some, it may be a little bit more difficult, but I would say it's fairly easy to understand. Ultimately, when you invest in a company, you can either invest as an equity holder, and this is talking ahead of the slides because it's going to come up again, but you can either be an equity holder where you buy stocks of Apple and you own shares of Apple. If Apple does well, you do well. If Apple does bad, the value of your shares go down with it, so you lose money. Bond is basically just a debt. Instead of just giving Apple money to invest and be a shareholder, you're just loaning Apple some money to create a new iPhone every September, right? And for that money in return, Apple is going to give you an interest payment every 6 months. They're all of them. Some of them can be every month, some of them can be quarterly, but usually if you're investing in a corporate bond, it's going to be twice annually that you're going to get paid. And then at the end of that term, whether it's 10 or 15 years, then you'll get the principal back plus your last interest payment. So in the event that the company defaults, that's why it's saying it's hierarchy of payment. In the event that it defaults, then you actually are in line ahead of shareholders and amongst other holders of the company as well. And then equity stocks, so long-term investment for growth, potential hedge against inflation, marketable, and then the disadvantages, it's obviously one of the most volatile, like we talked about right now. If Apple does really well, great, you did good. But if Apple goes down 20 or 30% and you have all of your money invested in Apple, then guess what? You're going to lose 20 or 30% of your portfolio as well. Potential lack of diversification, company and industry-specific risk. So potential lack of diversification is kind of that example again. If you give me $100,000 and I put all of it in Apple, I'm hoping Apple does really well because all of my eggs are in that one basket. But that's not a smart way to invest. So you want to diversify, and if you still love Apple, that's great. But you want to make sure that you have different pieces in your portfolio. The market only moves 3 ways. It only goes up, it goes down, and it goes sideways. Those are the only 3 ways it moves. So you want to make sure that you have pieces in your portfolio that respond well when the market goes up. You want to have pieces of your portfolio that respond well when the market's sideways and just kind of flat and not really moving at all. And then there are investments that have an inverse relationship where when the market's going down, these particular investments go up. So you want to make sure you have a little bit on each side. And that's just one very simplified way that you can diversify. So So what should we do? Statistics show that the best penalty kick strategy for goalkeepers is to stay in the middle, but they jump left 94% of the time. So ultimately, at the end of the day, if you're confused, a lot of times what I've seen is that when people don't know what to do, they just don't do anything, which is not the best strategy. The best strategy is to just pick up the phone. Here we are again at the end where it shows you the telewealth conference, and reach out so that way we can sit down and discuss your specific situation. You may not be as in bad a shape as you think you are. You may be doing very, very well. And that reassurance of me telling you that you're doing very well and to keep continuing to do what you're doing might very well go a long way. But if you're not doing well and there are a lot of boxes that are left unchecked, then it's best to handle that now. That way we can get in front of it and then we can help you devise a plan. On our end, you get way more than just the investment management side. A lot of times when you sit down with a money manager, they're gonna ask you, they're gonna basically just want to know what you have to invest. A lot of times they're not gonna go through the process of finding out if you should be investing at all. They just want to know what money do you have in savings, what money do you have at your other brokerage firms, where are your IRA accounts at, and how can I get that money over to me so I can invest it for you and then charge you a fee. To me, that's a disservice. There needs to be the financial planning conversation that is a part of the investment conversation, not just the investment conversation alone. If you walk into my door with $50,000 and tell me you just want to invest something and that's it, then most of the time it's going to be really hard for me to work with you, because in order for me to do my due diligence and be a fiduciary, I need to know more than this $50,000. I need to know a lot more than that in order for me to help you be successful. And the more information you provide for me or any planner, the better you are. And so I will leave that to, I'll kind of stop there. I know I kind of threw a lot at you guys in a very short period of time, but if you guys have any questions, I'm pretty sure there was some possibly popping up in the chat, so I'll turn it over to you, Nick.
Sounds good, thanks. So yeah, the first question that we have is, if you have an IRA and a 457, can you contribute $19,500 to each, or can you max out one and stop funding the other?
Great question. So you can absolutely max out your 457 at $19,500. If you also have a traditional IRA, traditional IRAs, Roth IRAs, they have different max contribution limits than employee sponsor plan. So right now, if you're under 50, the max that you can put is $6,000 into your IRA. If you're over 50, you have $1,000 catch up, so you'll be able to put $7,000. Now, there are other rules that are attached to that, based on if you're doing a traditional IRA and you're investing primarily for it to be tax deductible. There are income limitations that determine whether or not you're allowed to deduct that whole $6,000 to $7,000 based on how much money you make. And if you're also contributing to an employee sponsored plan already, then there's going to be a break and says, okay, you might not be able to deduct the whole 6 or 7, but maybe you can deduct a portion of it, or maybe you just can't deduct it at all. And in Roth IRA, same scenario. You have to actually, there's an income limitation that determines whether or not you can contribute the whole 6 or 7,000. With the traditional, it's whether or not you can deduct it. The Roth is whether or not you can contribute at all based on your income. And then we can sit down with you one-on-one and determine where you're at and where you fall within the IRS guidelines. And if you can do both, and if you can, great.
Awesome. Thank you for your answer, Marcus. All right. So the next question here I have is, I am like a paraprofessional teacher. I do not make very much money. I have at least 12 years before I retire. The only debt I have is a student loan. What can I seriously do to plan my retirement?
That is a good question, and that's a question that probably comes up quite more often than you probably might think. I would say that might be one of the one-offs where we sit down specifically and discuss your unique situation, and I'd be happy to sit down and if you want to schedule a telewealth call, then I'd be happy to sit down and discuss your situation specifically. I mean, in terms of what you can do, definitely you want to take advantage of your retirement plan at work. So if you're working for a school district that offers a 457 and 403B, and your only debt is student loan, and let's assume that your other monthly expenses are being met, and you still have a little bit of money left over, I would slowly start putting a little bit more money into my retirement plan, your 457 or 403B, even if you're putting in $20 a pay period, and then slowly you're increasing it. Because I guarantee you that happens all the time. Once the money, it's different when you have to take it out of your bank account and then put it into somewhere else versus when they just take it out before you even get your check. So I would start there by just at least figuring out what can I comfortably do every check to start saving for retirement. Can I do 20? Can I do 15? Can I do 50? And then as time goes on, then say, you know what, that didn't hurt me too bad. Let me increase it by another 10 or 15 or $20. And then you just continue to do that. You have 12 years left to go, so that there's still time. And so, but like I said, one thing is we could just sit down and have a private conversation, but that would be a first place I would start if you're not doing that already.
Great, thank you for that. So I don't have any more questions that have come in so far. So if anybody else has any other questions that Marcus can answer for you, please send them in the chat here or the Q&A, and we can definitely get them answered. If not, his telewealth link, definitely reach out to him and speak to him on a one-on-one level.
Sounds good. Well, I don't know if anybody still is, I don't know if we still have a lot of people left in the chat or not.
We do not have any more questions that came in through the chat so far. There's a few people logging off, but that is it.
Okay, perfect. Well, I'll just leave it and say thank you guys for joining the telewealth conference today. Please don't hesitate to reach out if you guys have any questions, and we'll be happy to help you guys out in any way that we can.